To keep yourself updated, subscribe to Indigo Learn and click the bell icon and download our app OneFin to start learning on the go.
Hi friends, let us now revise another major unit and a very important unit from the examination point of view, that is financing decisions. As we said, we will revise all the important practical topics which are important from the examination point of view, and from the examination point of view, financing decisions and the chapters in financing decisions are extremely important, at the same time are very scoring. Alright, let us now get into the topic. The main unit is called financing decisions. As a matter of our practice, how do we understand the concept with the help of the name? Financing decisions. The decisions taken with respect to the financial sources of the company is called as financing decisions. Now friends, if you observe, our entire syllabus is a set of various decisions to be taken. All the topics in our syllabus is what I am talking about. Now how do we understand this? Let us take the help of the balance sheet. Let us see in the horizontal format. What do we have in the balance sheet? On the liability side, we have equity share capital, preference share capital, reserves and surplus, then some debentures and some long-term loans. Also some short-term current liabilities. Now on the asset side, we have something called as fixed assets, then investments majorly, and then current assets. These are the main items usually we see. Now, the decisions which are concerned with respect to the financial sources. What are the financial sources? We are talking about the long-term financial sources. We have only two types of sources. In short, we can call them as own funds or loan funds. So, the decisions which are associated with that of the financial sources of the company are called financing decisions. And the decisions which are in connection to or which are associated to the investments are called our investment decisions or capital budgeting decisions. And the decisions which are connected to our current assets and current liabilities, our language, working capital, are called as working capital decisions or working capital management. Then to extend further, the decisions what we take after arriving at the profit, whether to distribute or not, if yes, how to distribute, that decision we will call it as dividend decisions. And one more chapter, that is our ratio analysis, which is a combination of all these things. We take all the elements of the financial statements, that is balance sheet and P&L account. We have already seen how to analyze the ratios. Now, coming to our main focus at this point of time, that is financing decisions. In this unit of financing decisions, we have three important chapters. 1. Cost of capital. 2. Capital structure theories and decisions, and 3. Leverages. Friends, as I mentioned earlier, all these three chapters are very important from the examination point of view, and trust me, they are extremely scoring, because you will have one of the mandatory questions from one of these three chapters. Cost of capital or leverages, for sure we can expect, even capital structure decisions also for that matter. Therefore, let us not ignore this. It is a very important area for us from the examination point of view. And let us now move ahead to the first chapter in the unit of financing decisions, that is cost of capital. Let us move ahead. So, our new chapter, cost of capital. Friends, in this chapter, we will majorly have to understand three things. 1. The introduction part. 2. Computation of specific costs. Now, what specific costs are you talking about? The costs of our sources of finance, be it term loan, debenture, equity, preference, retained earnings, like this. And lastly, computation of overall cost of capital. Now, why do we have to do this? Our company will not have only one source of capital, it will have different kinds of sources. So, now when all of them are there, what should be the cost? How do you compute the overall cost of capital? In short, the overall cost of capital itself is the cost of capital in general, how we call it. That is the terminology used. Now, talking about the introduction part. Initially, before we go into the concepts of specific cost and overall cost, we have to understand a few things here. First of all, what is the meaning of cost of capital? And 2, what is the significance of Cost of capital. Now, these are the two things which we are supposed to understand before jump into the main area of computation of specific cost and then overall cost of capital. Now, what is the meaning of cost of capital? Cost of capital. Now, there is a capital, for that there is a cost. Usually, costs are understood as two types. One is called implicit cost and the other is called explicit cost. Now, this implicit cost means an implied cost. Explicit cost is an expressed cost where we can compute. If you, once we go further, you will understand what are that we will actually practically compute and what are that we don't have to compute, but we will understand, yes, there is a cost for it. Now, before that, first of all, what is the cost? To understand this, let us take a small example. Let us say, I wanted to borrow some 10 lakhs. So, you have given me 10 lakhs. You said, okay sir, I will give you some 5 years time, you please take 10 lakhs and then repay. Now, will you simply give me 10 lakhs like that? There will be some expectation. What is that expectation, sir? Because I am giving 10 lakhs. So, what you do is every year you pay me some interest. Alright. At what rate? Say for example, 10% per annum is the interest. Great. Now, in our timeline, 1, 2, 3, 4, 5. 10 lakhs is what you gave me today. At the rate of 10% is what you said. Nice. Now, what is 10% of 10 lakh? 1 lakh. So, what is that you are expecting? 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh. At the end, the 10 lakhs, the principal amount. Now, what is the cost of this capital for me? Array, 10 lakhs I am getting it, I am using it, I am repaying it. But to get that 10 lakhs, am I not incurring the cost of 5 lakhs? Absolutely yes. Now, this 5 lakhs is my actual cost. Therefore, to get to 10 lakhs, I had to incur the cost of 5 lakhs and this is the cost of the capital. No, this is the normal language. But when it comes to financial language, what is that 1 lakh or 5 lakhs? Our interest. Now, this interest is our cost, clear. But if it is 5 years, I say 1 lakh per annum, therefore 5 lakhs. If it is 7 years, the cost is 7 lakhs. If it is 3 years, the cost is 3 lakhs. Now, end of the day, how do I generalize it in the simplest form of expression? Somebody will ask me, sir, what is the cost percentage? At what rate are you incurring the cost? Therefore, our costs will always be expressed as a percentage. Here, we know straight away my cost of this capital, because it is a loan, my cost of debt capital is 10%. Now, like this, just like for a loan, for equity also there will be a cost, for debentures also there will be a cost, for preferentials also there will be a cost. Yes, every source of capital will have a cost. Just that these major sources, that is our debentures, term loans, equity and preference, they will have explicit cost, which is expressible and computable, whereas our retained earnings will have an implicit cost, that's an implied cost, it's an opportunity cost. So, what we will say, what is an opportunity cost? Instead of keeping the funds with you, you please give me, no, I can invest somewhere else and get some money. Now, that is also a cost for the company because it is an expected return for the investor. Therefore, this expected return of the investor here becomes the cost for the company. So, this is the basic meaning of cost. Now, coming to the next part, that is what is the significance of cost of capital. Now, why should I know? What is the purpose of knowing cost of capital? In what way will it help me? Friends, please understand, when we are supposed to make a decision, our fundamental rule is the benefit more than the cost or not? Yes or no? Yes. To know whether benefit is more than cost or not, should you know what is the cost? Absolutely yes. Only when the benefit is more than the cost for any decision, any financial decision you take, only then you say, yes, it is a financially viable decision. Therefore, to understand whether the benefit is more than the cost or not, our cost of a capital, computation of cost of capital will be helpful. To be even more precise and conceptual here, in our investment decisions, if you remember what we do, how do we make, and the most popular method is computation of NPV. Now, in what you do in the computation of NPV, are all present value of cash inflows minus present value of cash outflows? Now, there is a time value of money involved. Here also, we saw 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh each year. It is not exactly 1 lakh boss. There is a time value of money. We have to bring it down to today and then compare with this. That is the initial cash outflow. Therefore, at what rate will we discount? The rate with which we discount is nothing but our cost of capital only. So, like this, our cost of capital has a very, very important role in our decisions to be taken. Let us now move to the main area, that is computation of specific costs. Now, what are the costs we are supposed to compute? What are the specific sources? That is, we will have to compute the cost of term loans, then debentures, then preference shares, then equity shares, and lastly retained earnings. So, as we mentioned, all the first four will be our explicit costs, that is direct costs, whereas the last one, that is retained earnings, will be under the category of implicit cost or indirect cost or opportunity cost. Now, in debentures also there are two types again, irredeemable and redeemable. So, our formula or concept to compute will be different for irredeemable and redeemable, same also for preference shares, irredeemable and redeemable. Now, let us first focus upon computation of cost of term loans. Friends, to understand this, we will just go back to this example of ours. Here what we said in the just previous example what we took, okay, I am borrowing 10 lakhs from you, for which I am incurring a cost of 1 lakh per annum. No sir, we said we are supposed to mention it in percentage per annum, standardized way of expression. Yes. Now here what we said, our cost is 10%. Now how did I arrive at this 10%? Very simple. For 10 lakhs, my cost is 1 lakh, because we are talking per annum, percentage per annum. Now, for 10 lakhs, if it is 1 lakh, then for 100, it is how much? Very simple, cross multiply 100 into 1 lakh divided by 10 lakhs. But if we express it in the right way, how do we express it? Okay, I will say, because we are talking about cost of term loan, I will say KT is equal to, this is our interest divided by loan amount into 100. This is the basic formula. Friends, if you remember, even in the main course what we learned, we said never by heart the formulae, kindly understand the concept. It will be easiest first. Even if you forget something, you can just recap the concept, then you can derive the formula also. Now, this is the basic formula, not the final formula. From here, we will have to understand certain things to arrive at the final formula. Now, what is that? Friends, we said interest primarily on the numerator. Say 100 is anyways fixed, there is nothing to discuss much about it. The only thing is, now the changes will be in interest and this loan amount. Now, first talking about interest. The interest has a special feature. What is that? When you have a debt in your sources of capital, debt has a benefit in the name of interest, because interest is tax deductible. Therefore, if a company has a debt source of capital, it is a benefit for the company. Why, sir? Because interest is tax deductible. Now, how is it beneficial for me? Okay, let us take a small example for this. Let us say we have two companies, X and Y, where X is purely equity, whereas Y is equity plus debt. Alright. Now, let us look at the tax impact. Now, how is the company Y, which has got a debt in it, is saving some tax? It's got a benefit of interest, because of which it is paying lesser tax. Now, how do we understand this? Okay, how do we start the game to compute tax? We have to start with sales minus costs, then EBIT minus interest, then PBT minus tax. Okay. Now, whether it is levered or unlevered, sales and cost term will be the same. The changes will happen after EBIT. Therefore, let us assume, let us start the game from EBIT. Let us say some 100 lakhs for both. Now, minus interest, if I say some 30. Okay, so for unlevered we will not have an interest. For levered, let us say 30 is the interest, some 30 lakhs. Now, what is our PBT? This will be 100 only, this will be 70. Now, let us say minus tax at the rate of some 40%. Now, what will be 40% of 100? Straight away 40. What is 40% of 70? 7 4 28. Okay. Now, friends, what is the tax paid by the unlevered company? That is 40. By the levered company which has a debt in it, it is paying only 28. It is paying lesser than that of this company. Is there no benefit for it? Yes. Now, why did this benefit happen? Because of this term called interest. Okay. Now, if you check what is the difference between this these tax values, 40 minus 28, something about 12. Now, how did we get this 12? Now, how did I get benefited to the extent of 12 lakhs? Simple. What is our interest? 30 lakhs. What is our tax rate? 40%. What is 40% of 30 lakhs? What is 40% of 30? Nothing but 12. Therefore, this reduction of payment in tax is a benefit for the levered company to the extent of how much? Interest into tax. Therefore, even though the outflow is interest, boss, I have a benefit of saving in the name of tax, because of tax. Therefore, we will not say simply interest, we will say net interest. Now, coming back to our formula, okay, this one we will write here. Therefore, my KT will be, not simply interest, interest minus interest into tax divided by loan amount into 100. Okay, can I further expand it and say interest into 1 minus tax divided by loan amount into 100? Absolutely. Now, one more special point about this denominator, that is called loan amount. If straight away I asked you, you gave me, that being the scenario, I being the company, say for example, that being the scenario, it is fine, we can write loan amount, no issues. But at times, to get the loan amount, the company, that is I, may have to incur some other costs also. Say for example, there is somebody called Mr. X who has referred, who told me that, boss, there is somebody who can lend you, but he says, I will charge some referral fee, I will charge some brokerage for it. Okay, no problem. Sir, but for that you pay me some 30-40,000. Okay, some 40,000. Okay, chalo. Now tell me, because I have to pay him 40,000, can I say when I repay you, I will pay you only 9,60,000? No. Boss, I am supposed to get 10 lakhs, but the 40 went to the brokerage. Therefore, what is the amount I actually received now? It is called my net proceeds. Therefore, whenever there are additional costs incurred to raise the term loan, such costs will be removed and we will compute only on the net proceeds. Therefore, our KT, that is cost of term loan, will be interest into 1 minus tax divided by net proceeds into 100, and this is our final formula of computation of cost of term loan. Let's now move to the next specific cost in the order, yes, that is debentures. Now, in debentures we said first we will talk about irredeemable and then we will come to redeemable. Cost of debentures, irredeemable. Friends, what are debentures basically? Debentures is nothing but a form of raising loan. In term loan, we are referring to only one party or few parties. But here, in debentures, there are n number of people. There are so many people involved. But still, we will take the full value. No worries. Now, how do we compute the cost of debentures, specifically irredeemable debentures? Now, the concept what we applied for term loans is the same for debentures also. This is also loan. Whether you raise from one person or 100 people or 1000 people, end of the day loan is loan, cost is cost. Therefore, firstly we will say cost of debentures, the basic formula I am coming to again. Is usually the same what we wrote there, interest into 1 minus tax divided by net proceeds into 100. This is our basic formula. Now, from this, how do we have to arrive to the actual formula? Conceptually, we will move ahead. Let us say, let's take a small example. Say a company has raised some number of debentures are 1000, raised 1000 debentures. Okay, with the face value of the debenture being rupees 100. All right, and then and the cost of the debentures is the rate of interest is say some 10%. All right, and tax rate is some 30%. Now how do we write the cost of debentures here? Now interest into 1, we have the formula here. So interest is how much? 10% on, okay. So interest is 10% on 100, correct? Okay. This is interest into 1 minus tax, some 30%. Now this is interest of one debenture like this. How many debentures are there? Some 1000 debentures are there, okay, divided by. Now what is our net proceeds? The face value is 100, okay, and how many debentures totally? 1000, okay, all this into 100. Now whether I write this 1000 or whether I do not write this 1000, will it make a difference for me? Absolutely no, because 1000 get cancelled. Therefore, one important point from here, please put in mind, from here we will only write the value per debenture, whether it is for irredeemable or redeemable or preference also for that matter. So hereafter we will write per security. Now, so the number is not material for us, because even if you write the full value, end of the day that will get cancelled. Why multiply and why cancel? So better for an easy way of understanding, we can directly write per security. Now this is how we compute. Okay, this formula is clear now. What if I have issued the debenture for 100, but I offered a discount of say some 5 rupees and I incurred a flotation cost of again some 5 rupees. Now what happened to my net proceeds? Is it equal to the face value? No. This 5 rupees plus 5 rupees, that is 10 rupees. I have incurred the cost, just like the previous example, brokerage, what we said in case of term loans. Now here what happened? So instead of 100, how much I received? I received only 100 minus 5, that is only 90. Therefore, this 100 will be 90. Why are we saying this? Because this is our net proceeds. Alright. Now, first of all friends, what is the meaning of irredeemable debentures? The debentures which are not redeemable. You will go on paying the interest only, they are not redeemed. Though it is not a popular practice as of now, but still conceptually I have to learn. Now what are we doing? We said some 5 years, 10 years back, the company has issued these debentures, irredeemable debentures. Now say for example, the company has, the securities are floating in the market. When you issued, it is 100. After some 10 years, say for example, it became some 400 or 500. Now tell me, the market value is much higher. Then in such case, will you still take the face value as the base or the market value? In such case, we will take market value but not the face value. This is the golden point what you are supposed to remember. Why, sir? Because whenever you are computing the cost for irredeemable, if market value is provided, boss, you are anyways not repaying the principal. Therefore, the cost has to be computed not just on the face value, but it is floating in the market. Therefore, prefer the market value. I repeat, prefer the market value for computation of cost of irredeemable debentures. I said prefer, meaning market value is not given in the question. Okay, take the book value. Take the net proceeds, in that case the net proceeds will become the book value. If market value is provided in the question, the golden rule is for irredeemable debentures, prefer market value only. Only if market value is not available, then choose book value. I hope I'm clear with this point. Therefore, what is our final formula now? KT is equal to simply interest into 1 minus tax divided by net proceeds into 100, where I is equal to interest and T is equal to tax. Now this is per security. Net proceeds is equal to market value preferably. If not available, then the face value minus any other this flotation cost or discount, whatever. This is also per security. So this is our formula of computing the cost of irredeemable. Oh, this is not T, I am so sorry. This is D. Cost of debentures, KD is cost of irredeemable debentures. The formula of cost of irredeemable debentures is therefore is interest in 1 minus tax by net proceeds into 100, where where we will take per security and the net proceeds, our priority is market value. If market value is not given, then we will go to book value. Let's now talk about the cost of redeemable debentures. Redeemable debentures. Now, friends, from the formula of irredeemable only, we will derive the formula of redeemable. Now, first of all, what are redeemable debentures? As the very name says, debentures which are redeemable. Okay. Now, say for example, there is no flotation cost, there is no discount, whatever is the face value you have given for, and you are also redeeming for the same value, then absolutely no issues in the story. The formula will remain to be the same. But life is not that easy. There will be complications. When you are issuing, you will be attracted, I mean the investors will be attracted only when you issue at a discount. Flotation cost you may have to incur for sure. Now, when you are redeeming, say after 5 years, 7 years or 10 years, now to make the policy attractive for the investors, what do you do? Arey boss, face value is 100, but I am giving you some 10 rupees discount. When I repay you after some 5 years, arey why will I pay 100 boss? I will pay you 110 you say. Then what happens? Obviously, people will think, I am getting there's an additional benefit. Now, benefit is fine for him, but is this not a cost for the company? Absolutely, it is an extra cost. Therefore, in our cost, in our formula, what is the cost? Till now only interest into 1 minus tax was the cost. Now I have some extra cost. What is that? Say for example, let's go back to the same example. Here we said our face value is 100, flotation cost 5, discount is 5. So what is the net proceeds I got? 90. Say for example, the redemption value is say some rupees 110. Oh, I am getting 90 per debenture, but I am asked to pay, I am supposed to pay how much? 110. Arey yaar, per debenture, what is that I am losing? 20. That 110 minus the 90? Absolutely. Is not extra cost? Yes, it is an extra cost. Now, what is my extra cost component? 110 minus 90. What is 110? My redemption value per debenture. Again, as we said, we will not talk about full value, we will talk only per security now. Now, this RV, that is redemption value, minus NP, is it not my extra cost? Absolutely yes. Therefore, I have to consider it. Therefore, my cost of debentures, if they are redeemable, will not simply be interest into 1 minus tax boss. I will also have to incur RV minus NP. One more point. Is this interest not per annum? Yes, it is per annum. We are talking about cost per annum. Now, this RV minus NP simply I take. Is it for 1 year or 5 years? Arey 5 years. Boss, tell me for 1 year. Oh, then what should I do? For 5 years it is so much, means for per annum what will I do? Divide by number of years. Am I right? Yes, the tenure is say some 5 years. 5. No, it's 7 years. 7. Now, this is fine. In the denominator what we have ideally here? Net proceeds. Correct? No doubt. But boss, is the redemption value and the net proceed both the same? No. Arey, I am getting 90, but I am paying 110. So, should I take 90 or 110 as the base? Don't worry, take an average. Therefore, when there is a difference in the amount, you will take an average. And this is our formula of cost of redeemable debentures. That's all, game over. Now, what is that special point what we are supposed to keep in mind here? That is, we said for irredeemable, the net proceeds usually we will take the market value. In case of redeemable, Babu, they are redeemable. So don't think of market, 5 years term is fixed, you know clearly. Therefore, we prefer, I repeat, we prefer from the examination point of view when we are computing, we prefer book values only for redeemable. So, for redeemable debentures, net proceeds is usually what? The book value. Book value means what you have? You have the issue price, the face value whatever, minus some discount, minus some brokerage, whatever. This will be our net proceeds. So, based on the book value we will take. Suppose book value is not given, market value is given. Okay, take market value, who's stopping? I said prefer. So, the golden rule, I repeat one other time, for irredeemable debentures, prefer market value to choose as net proceeds. For the redeemable debentures, prefer the book values to choose as net proceeds, and that's it. So with this, we are done with the computation of cost of redeemable debentures. Let us now move to the next specific cost, that is cost of preference shares. Friends, just come back to the list of the sources. Even for preference shares also, we have redeemable and irredeemable, just like in the case of debentures. So we will also follow the same kind of pattern for preference shares. Alright, therefore, cost of preference shares. Now, so how do you compute the cost? We will call it as KP. First we are talking about irredeemable preference shares. Now, what is the cost? Okay, let's go back to the debentures. What is the cost? Interest into 1 minus tax divided by the net proceeds. Now, interest is what is paid because of raising the debt. Now, what is that paid because of raising preference share? Preference dividend. Therefore, preference dividend. Now, there interest we said into 1 minus cost, but is preference dividend tax deductible? No. After paying tax only, we have something called profits, out of which we will pay for preference shareholders. Therefore, preference dividend is not tax deductible, friends. Preference dividend is paid only after paying tax. Therefore, it is simply preference dividend divided by net proceeds into 100. That's all. Now, I repeat, when we are talking about irredeemable, what will be our net proceeds? That is our golden rule. For irredeemable, net proceeds will be market value preferably. If the data of both market value and the book value, historic value, both are given, should we choose the historic value or the market value? Market value only, because we are talking about irredeemable. One more additional point here. Now, at times the question may say the company is bound to pay some corporate dividend tax or dividend distribution tax. No, that has to be paid by the company. Therefore, this will be the additional burden for the company. How much? Same, this preference dividend into that CDT, the corporate dividend tax. Therefore, this formula will now change preference dividend plus preference dividend into corporate dividend tax divided by net proceeds into 100. Now, can we write this as preference dividend into 1 plus CDT divided by net proceeds into 100. Therefore, cost of preference, irredeemable preference shares will be this. Now, let us move to the redeemable part. Redeemable preference shares. Now, same, what is the formula in case of debentures? We said interest into 1 minus tax plus RV minus NP by N whole divided by RV plus NP by 2. Absolutely the same. Only difference, what is that? Instead of interest, what happens? We will have preference dividend plus RV minus NP by N whole divided by RV plus NP by 2 into 100 is the same. Is there any change what we see here? Absolutely no. Friends, just like our interest, even preference dividend is also a fixed cost, a committed cost. Therefore, the nature of computation of cost is the same. Only thing is there interest is tax deductible, therefore we said into 1 minus tax. Here preference dividend is not tax deductible, hence we will not write it. And this is the formula of cost of redeemable preference shares. And one more golden rule lastly, here NP is what? Historic cost, the book value, the historic value. Therefore, here we will say book value. That can be the issue price minus flotation cost if any, minus discount if any. This is our net proceeds in case of redeemable. That's it. Friends, let us now move to the next specific cost, that is cost of equity. Now, In computation of cost of equity, we have about 6 models, that is dividend price model, earnings price model, dividend growth approach, earnings growth approach, realized yield approach and capital asset pricing model. Alright. But before we go into the models, first of all we have to understand, does equity have a cost? Friends, in case of term loans or debentures, we are supposed to pay some interest. We said it is a cost acceptable. In case of preference shares, we are supposed to pay the preference dividend. Yes, it is a cost acceptable. Now, irrespective of profits being earned, interest has to be paid. Yes. If profits are earned, first of all, they go to the preference shareholders. Therefore, that has to be paid. Is there any mandate that the company has to pay dividends to the equity shareholders? There is no mandate. Oh, then there is no cost. I said there is no mandate, but I cannot say there is no cost, because there is another side of the coin for this cost. What is that? That is called expected return. Now come back. In our term loans or debentures, whatever we are paying in the name of interest and we are calling it as cost, say I am the company, for me I have borrowed money, I am paying interest, it is cost for me. But the one who lent me money, for the lender, this interest, the same interest which I am calling as cost from my side, from his side, it is expected return. He is expecting something in return for what he has given me or for what he has invested in me, in the company. In the similar lines, preference shareholders also, the preference dividend also is the cost for the company, preference dividend is the expected return for the preference shareholders. Now, your lenders, they have some expected return. Your preference shareholders, they have some expected return. Can your equity shareholders also have some expected return? Obviously. Why will they not expect, then why will they invest? Now, this expected return becomes the cost for the company. I'll tell you what, in fact, the cost of equity is always higher than the cost of debt. For sure. Why? There is no mandate, there is no obligation, then how can we say the cost is higher? Boss, they are equity shareholders. They have trusted you, they have trusted the company. Now, how can they not expect more? I'll tell you one small example. Let us say there is a person called A. A has another very good friend called B. Now, A and B wanted to start a company. Well, they invested some amount. Now, they took the support of their other little distant friends C and D. Now, after some time, they realized, no, even this is not sufficient. They wanted to go for a bank loan. Alright, they went for a bank loan. Now, primarily there are 3 types of parties in this investment. AB, like our equity shareholders, CD, like our preference shareholders, and the banker, the lender. Now, what happened? There is an agreement between AB and CD saying that CD will say, boss, we will trust you because we are good friends, no worries. But you pay us whenever you are getting profits. So, you pay us in priority. Okay, out of profits, whatever you get, say for example, you pay us 2 lakhs monthly. Alright. Now, banker's loan, say for example, is per month, it is 1 lakh. Alright, let us understand in this way. Now, as time is passing, every month, by end of the month, the company has to pay the interest. So, the banker comes and sees. Company is in a very bad state, not yet grown, still struggling, they have not made profits, they are still struggling to, get their work done and generate revenue. Now, do you think the banker will wait? Will the banker say, oh, no problem my boy, take your time, Aram say, no, he will not. He will say, boss, time up, give me money. Every month same story, 1 month over, 2 months over, 3 months over. Now, the company is still not in a good position, it is still struggling. He doesn't bother. The lender is not bothered about the profits. His interest has to go. His 1 lakh has to go. Alright, 6 months over. Suddenly what happened? After 6 months, suddenly the company has shown some profits. Say about some 3 lakhs or 4 lakhs profit has come. Now, do you think, can you tell the banker when banker comes, can he come and ask, now you made profits, you pay me 1 more lakh extra? No, boss, you are fixed. Whatever 1 lakh we are paying you, we will pay again 1 lakh we will pay. Over. After that, we are left out with some profits now. Now, what will happen? This 3 lakhs or 4 lakhs, whatever is there. Now, who will take it first? Obviously, C and D will take it first as per the agreement. Now, did A and B enjoy anything till now? Again, one more month over, same scenario. Banker comes, we are not paying him extra. Whatever profits are there, we are distributing to C and D. Suddenly, after 10 months or 1 year, the company has seen profits of say some 50 to 20 lakhs. Now the banker can he come and say, boss, 20 lakhs is a big number, therefore give me money. No, 1 lakh fixed over. Whether I am making profits, irrespective of that fact, whatever I am supposed to pay you, I am paying you 1 lakh over. Then to C and D, A and B will have to pay the 2 lakhs or 2 lakhs, whatever is the agreed amount, over. Now B is asking A, I want, give me some money. A says, okay, we will do one thing. You also take 1 lakh. Then what will B say? Hello boss, why am I taking 1 lakh? I gave the banker 1 lakh, you also take 1 lakh. Hello, I am the investor, I am the equity shareholder, I trusted in you. Even though when the company did not make profits, I did not ask you anything. What did the lender do? He came irrespective of the situation, performance of the company, he wanted his amount. He took it away. Even when we made profits, did I ask you? No, because we have a priority shareholders, therefore we have to give them, therefore you gave them too. For somebody who didn't even trust in you, who didn't even bother about your returns, you paid him 1 lakh. And somebody who wanted priority when profits came, you paid him 2 lakhs. Now will you pay me also 2 lakhs? Impossible. I expect definitely much more than these people. Yes or no? Yes. B has the right to say that because he has waited all along. He has trusted the company. He didn't ask for any priority. He didn't wait. He waited for the profits. He didn't bother about his money. Now, therefore, friends, what is the essence of the story? Here, A and B, as we said, are our equity shareholders. C and D are preference shareholders, and there is a lender. The example, banker. Now, whatever is the interest which is payable for the term loans or debentures, it is say some 10%, say. The preference dividend usually will be slightly higher than that of this cost. Say some 12%. Now, the cost of equity, forget about 10, forget about 12, it will be definitely much more than these two because they have waited so long. They have trusted the company. Therefore, the expected return of the equity shareholders is very high, meaning the cost of equity for a company also will be the highest of all the other costs. So, this is the essence of the story. So, long story short, there will be cost for equity also. There will be cost because the expected return is high. In case of your debt, friends, the risk is low. Come what may, the amount has to be paid. But what is the fate of equity shareholders? Nobody knows. Parallelly, the expected return of the equity shareholders is also very high, and hence the cost of equity will be the highest of all. So, this is what we are supposed to understand. Now, let us move into the methods and understand what are the different ways of computing our cost of equity. Cost of equity. We said there are 6 models. 1. Dividend price model or approach. Then earnings price model or approach. Then dividend growth model or approach. Then next will be what? Same earnings growth model. Then realized yield approach or model, or yield to maturity model. It's called YTM model in short. And lastly, CAPM model. Now, so these are the different models, friends. First, we will talk about the dividend price model. As we always know, the name itself will give us the answer. Dividend price model. What is this dividend price model? What is cost of, how do you compute costs basically? Equity will be KE, cost of equity. The cost divided by the net proceeds into 100. Okay. Now, what is the cost here? We are talking about the first model. Dividend is the cost. See, as I told you, it is not mandatory, but once profits are there, there will be a policy in the company. Therefore, whatever is the dividend paid or payable will become the cost. Therefore, this is DPS divided by price. What price are we talking about? Shall I say net proceeds here? Friends, unlike in the case of debentures or preference shares, we don't have redeemable equity shares here. Equity itself is by default understood to be irredeemable only. Therefore, what will we take? The moment we say irredeemable, market price. So, the price here refers to market price. So, it is called dividend price model, idea dividend market price model. Why? Dividend on the numerator and market price on the denominator into 100. That's all, as simple as this. Now, market price is also indicated as P0. Therefore, DPS by P0, the current market price into 100. As simple as this. Okay, just in case you have any flotation cost. Okay, no problem, remove it. Net proceeds, then we will call it as net proceeds or net P0. Here we will not use the word net proceeds. For equity, we will call it as net P0. P0 or P0 minus flotation cost. Now, if DPS by P0 at 100 is the dividend price model, what will be the earnings price model? Instead of dividend, put earnings. Now why should earnings become the cost? Friends, first of all, earnings belong to whom? Obviously, whatever are the earnings left out after addressing the preference shareholders, they are called what? Earnings available to equity shareholders. They are the earnings of the equity shareholders. They are the owners of this fund. But are they getting the full amount? Or as per the dividend policy of the company, if it says 60% is the payout, they will not get the entire amount. Say if 10 lakhs is left out, they will get only 6 lakhs. But ideally tell me, they are given 6 lakhs. No, just because the company is paying 6 lakhs, do you call it cost? Or whatever is the fund of theirs, should that be considered as the cost? This is the second approach. See the different models. I don't say first is wrong and second is right. According to dividend price model or approach, dividend is considered as cost. According to the earnings price model or approach, EPS, just like there we took DPS. We are all talking everything per share basis, right from the first formula if you remember. Per security, per debenture, per preference share. Here also that's one. Therefore, just like DPS, we will have EPS divided by P0 into 100. Now, this dividend price model and earnings price model usually are followed when there is a constant policy for the company in payments of dividends. Now, is that practically possible? Definitely, there is certain amount of growth rate expected to happen. And even the equity shareholders, they also expect some growth in the dividends, whatever they are getting. So, that is a general formula, that is a general practice in fact. Therefore, we should not ignore the growth is what included in that is why it is considered as a dividend growth model. So, whatever is left out in the earlier ones is now addressed, and hence what happens here, KE will be, now we are talking about dividend growth. So, first dividend will be there on the numerator, then in the denominator what happens, we have our market price, that is there, no problem, into 100 plus G, that is the growth rate, into 100. Now, growth if you are writing as 5%, directly you can write 5, but if you are writing 5% as 0.05, again we have to say into 100. That is why I put this. Now, why did I leave the blank for DPS? I could have written it. Now, as per the dividend growth model, every year what is happening? The companies, see whatever is the price current share today, because of this what happened at the end when there are profits. Now, to whom are we paying the profits? To the equity shareholders in the name of dividend. Now, when is the dividend paid? Today or at the end of the year? End of the year. Forget about interim dividends, not about the, that's actually a separate case. But in general, dividends are paid at the end of the year. Therefore, for P0, we will not take D0, that is today's dividend, we will take D1. What is D1? Dividend to be paid at the end of the year. Okay, then how do we get D1? Very simple, whatever is the dividend of last year, add plus G. Therefore, where we will say D1 is equal to D0 plus D0 into G, percent, D0 common, D0 into 1 plus G. So, with this we will get what is our D1. In the same style, In earnings growth model, KE will be EPS by P0 into 100 plus G into 100. Now, earnings we cannot promise as to there will be definitely increase or decrease, therefore, we will say simply EPS. And these are the basic first 4 models. Out of all the 4, if you ask me, sir, what is the most popular model? I will say, not I, the concept says, the textbook says, this is the most practical or most frequently used method or approach for the purpose of computation of cost of equity. I am talking till here. Next, we have what is called as realized yield approach or yield to maturity model. Now, what is this? Friends, if you remember, we learned the concept of IRR while learning the capital budgeting decisions. Absolutely. The yield to maturity is nothing but our IRR. Meaning, we said if we take a timeline 1, 2, 3, 4, 5. Now I am talking from the company's perspective. From the company's perspective, what happens? Say, company has raised some 10 lakhs. Absolutely yes? Yes. Now, every year it is paying some 2 lakhs, 2 lakhs, 2 lakhs, like this has been paying, it has been paying. Now, this 2 lakhs is generated from where? From the 10 lakhs only. Now, this 2 lakhs I am considering it as the cost for the payment made by the company. Now, if you say 2 lakhs, 2 lakhs, 2 lakhs from 10 lakhs, at what rate is this 2 lakhs generated? Is the question. Is this not similar to our IRR model? Absolutely, but the only thing is there in capital budgeting what we did, we had the cash inflows, these are called annual cash inflows, or the other name what we gave it as CFAT, and there we had initial cash outflow. What is IRR? The rate at which the annual CFATs when discounted to will be equal to the initial cash outflow. Did you not say that? The same, but there we used this angle, reverse angle. But here what are we talking about? No, not this, not this, not this. We said here we will take in this perspective. Perspective is maybe different, but end of the day mathematically it is the same. Just like as we said, our two sides of the coin, that is our cost and expected return. Same thing. Therefore, what is our yield to maturity or realized yield approach? Nothing but our computation of IRR. So, what happens here? We will be given the rate of the investment, we will be given the rate of the annual cash flows. We will have to compute at what rate. Now, I am changing, I am not calling it IRR, because if it is IRR, it comes from upside to downwards. Here, I am talking at what rate are these cash flows generated from the investment made is called our realized yield or yield to maturity. So, this is about our realized yield approach, and the last one, that is CAPM model, which is called as our capital asset pricing model. Okay. Now, CAPM. According to this model, KE is equal to, now unlike in the other models, we are not trying to derive the formula, we will write the formula and then understand what it is. RF plus beta into RM minus RF. Now, unlike the other ways of learning and understanding, why did we not first derive and then write the formula? Because friends, ideally speaking, to derive this, we will have to go to SFM of our final, CA final, where we will know the derivation of this formula of K is equal to RF plus beta into RM minus RF. Therefore, as we are not in that stage, for the time being, for us to understand, at least not blindly by heart, but for us to understand what is this formula telling us, we will take few minutes to understand the concept. Now, RF is our risk-free return plus this beta into RM minus RF is called security risk premium. This is our KE. This is the conceptual meaning. This is the formula, this is the concept. Now, what is KE? Cost of equity. Now, to understand this formula, we are now shifting our side. Towards where? Not from the cost side of the coin, we are talking from the return side of the coin. Meaning, KE is cost of the company, no doubt, but is it not the expected return of the investor? Yes. So, we are talking in that angle, and that expected return is nothing but the cost for the company, and hence we will see from that angle. Now, what is this RFR and what is SRP? RFR is, we said, risk-free rate of return, and SRP is security risk premium. Now, what is the idea behind this concept? Friends, the idea of an investor investing in a company is, as such, without the company, there are places where a person can invest and get some minimum rate of return guaranteed. I repeat, we can invest in some places which can give us some minimum rate of return guaranteed. Say for example, I will invest in my bank. There is something called as a fixed deposit. So there is some rate for it, some 4.5% or 5% or 6%, whatever. Yes, there is. Now, is it guaranteed? Yes, it is guaranteed. There is something called as, we can invest in post office. There is something called as a PPF, which will also give us some guaranteed, but there's got some timeline to be blocked. But end of the day, are there not options where I can invest in government securities? They are also guaranteed. But the problem here is, they are very less in number. Say some 6%, 7%, 8% maximum. Now, a person might think, why invest there? Because there is no risk. Now, somebody has got the risk appetite. He says, I will take risk, no problem. I will take risk, no problem. Now, why will somebody take risk? Because he or she is expecting a higher return. If you don't want a higher return, why will you take risk? Or the other way around. I will take risk because I want a higher return. Therefore, what is this investor doing? The person who has got the risk appetite, he says, no, I will not simply invest only in guaranteed returns. No problem. I will take risk of investing in a company. It doesn't guarantee me anything, unlike the post office, unlike the government securities, unlike the bank fixed deposit. But if I take the risk of investing in this company, there is a possibility of higher return. Yes, there is a possibility of higher return. Why did I use the word possibility? Because it's not guaranteed. So, if it is possible, if the company actually really works well, will the investor not get a higher return? Definitely yes. What is 7%, 8%? He may also get 13, 14%. Yes. Now coming to our concept. Here, the expected return of the investor, the language is like this. What he will tell to the company? See boss, outside I have places. I have options where I can invest and get some minimum guaranteed return. That is called as risk-free return. The return which is free of risk is our risk-free return, where our government securities, bank fixed deposit like this. Boss, I have an opportunity there, but I am taking the risk of investing in your company, even though there is an option available there. Therefore, I will expect at least over and above this risk-free rate of return. Yes, therefore, the game starts with at least risk-free rate of return and more. No, at least he doesn't stop there. He says and more, that plus above that, even not even equal to. So, if he really is happy only with the risk-free return, why will he come and invest in the company? So, the idea is, so the expectation of the shareholder KE is the risk-free return plus some premium. What premium? That is called as security risk premium. Now, if you look at the formula, in this formula, RM minus RF, this term is called as market premium. Only this term. Now, this beta into RM minus RF, what name did we give for it? Security risk premium. In the previous one, the word risk is not there. Why did the word risk come here? Because this beta came here. Now, to simply understand, what risk are we talking about and what is this premium? Friends, market premium is very simple. The market return in general in the market from all the companies put together is definitely higher than risk free. That is why you are coming there. Now, the premium, that is, it should be above the risk-free rate and below the market rate. Now, that is called as the market premium. That is the premium. Premium is what? Basically, premium means the excess. The return expected in and above the rate of risk-free is called as our market premium. That part is simple, clear. Now, what is the security risk premium and why did this beta add the word called risk? To understand this word risk, we will have to understand, boss, basically risk is of two types. One is unsystematic risk. The other is called systematic risk. Friends, please don't go by the words, the general meanings. Why is it very unsystematic? Why this is systematic? No. Here systematic refers to the system's risk, that is market risk. Then what is this unsystematic risk? Not related to the market, meaning it is a company specific risk. This is a company specific risk, this is market risk. So, whatever is the risk are two types. One is what are the risks which are company specific, it is controllable by the company. Now, for example, there are some issues with the company, then what can the company do? Certain things it can repair itself, or the investor can choose a portfolio and diversify the risk. Diversify meaning reduce the risk. So, this risk is diversifiable. Now, when I said this is diversifiable, what should this be? Obviously non-diversifiable. But why is it non-diversifiable? Because here we are talking about such risks, such factors which are not under the control of the company. Can the company control the inflation happening in the market? Can a company have a control over the interest rates prevailing in the market? Can a company have a control over the government policies? No. Therefore, the risk associated with the market and the market as a whole, it's a macroeconomic risk. It is non-diversifiable. Now, the moment I say, boss, there is some risk which is diversifiable, then what you will say? Then diversify. Diversify. Why are you asking for a premium for it? The risk which is diversifiable, nobody will expect anything. When it is possible, then repairable, repair. Which is not possible, which is not diversifiable, this you cannot diversify. But still, the investor says, boss, I am investing in your company. Now, therefore, I know there is a risk which is not diversifiable, but still I am investing in the company. Therefore, I want premium. What premium? What is the premium asking about? It is telling about the security risk premium. Now, to understand the security risk premium, first of all, let us understand what is this beta. What is this beta? Friends, beta is basically a sensitivity indicator. What sensitivity indicator? Beta is a sensitivity indicator of the sensitivity of the company's security with that of the market. I repeat, beta indicates the sensitivity of the company's security with that of the market. Okay, in other words, in a simpler language, we can say, for every 1% change, in the market return, by what percent or how much will be the change in that of the company's return? This is not something like our leverages? Yes, something like leverages only. Now, beta, but here is an indicator of what? Leverage we spoke about the internal items, but here we are talking about the sensitivity of the company with that of the market. Say for example, the market's return has increased by 10% in the last 1 year. If beta is equal to 2, then what does it indicate? Now, when will beta be 2? If market's return has increased by 10%, but the company's return has increased by 20%. Now, what is beta? 20 by 10? 2. So, if beta is 2, now next what can we predict? Oh, if market increases by 20%, then what will be company's return increase? 20 into 3, 60%. Now, do you think beta being 2 is very, very good? Boss, it is not only on the upside, sensitivity is also on the downside. If beta is 2, if market return falls by 50%, then what happens to the company? Company's return falls by 100%, it collapses. Therefore, having high sensitivity is dangerous. Usually, the sensitivity factor is somewhere plus or minus 1, but it is never 1. Why never 1? Why can't it be 1? If sensitivity beta is equal to 1 means what? Just look at the formula. We said K is equal to Rf plus beta into Rm minus Rf. If we say beta is equal to 1, what happens? It will be Rf plus Rm minus Rf, gone. Then what will be the expected return? As that of the market. Now, when is this? This is an exactly ideal situation. But tell me friends, is it practical? Is it practically possible to have beta 1? Will the company's performance exactly replicate that of the market? Impossible. It will be plus or minus. That is why I said usually beta is plus or minus 1. Now, the higher the beta, if the performance is increasing, it is good. If the higher the beta, it is good, but higher the beta, it is riskier also. Why? For 10% change, it is falling 20%. If beta is 3, practically it won't be 3, but just for understanding, I am telling you. If it is beta is 3, for 20% fall in the market return, the company will fall by 60%. Therefore, there will be a higher impact, which is not at all expected, because that is completely risk oriented. Therefore, this risk, which is risk? The risk of the company associated with that of the market is the beta factor. This is what kind of a risk? This is a systematic risk. Systematic risk is non-diversifiable. As it is a non-diversifiable risk, now what is happening? I am expecting a security risk premium. Therefore, what is happening? I am expecting, boss, above this risk-free rate, I am expecting this. Therefore, in now common man's language, what is this? The expectation of the investor for investing in the company. Now, what is the expectation? Some minimum risk-free rate, guaranteed rate, whatever is the minimum rate available in the market, plus a premium for what? For the risk of investing in the security of the company. I repeat, what is this SRP? We said this term is SRP, that is security risk premium. Now, what kind of a premium is this? It is the premium. It is a premium expected for taking the risk of investing in the security of the company. So, in the reverse order, we will understand this. Therefore, this K is equal to R plus beta R minus RF is our expected return of the investor, which gets converted as the cost of equity of the company. So, this is about our CAPM model. Let us now move to the last specific cost, that is cost of retained earnings. Friends, till now, whatever costs we were talking about, the sources, they were all raised. Equity is raised, preference is raised, debentures are raised, term loans are raised, but are retained earnings raised? No. Retained earnings are the earnings retained after addressing all the costs. Then, where will there be any cost for retained earnings? Now comes our point of implicit costs. We said certain costs are directly computable. Yes, all the four what we have seen till now. Now, the cost of retained earnings is not computable. It is not an explicit cost. It is an implicit cost. It is an indirect cost. It is an opportunity cost. Why opportunity cost? Okay. Say for example, the company has retained some earnings with it. It is not distributed as dividends. Now, what will I being a shareholder say? Boss, if you are retaining it, then use it properly for a productive purpose. If you are not able to productively invest it, boss, give it to me. I have another opportunities. I know how to get some 12%, 13%. If you invest somewhere and get 10%, what is the point? Now, what is happening with retained earnings? Retained earnings, to retain, you don't have to incur any cost, but there is an expected return of the shareholders from these retained earnings. Therefore, it is called as implicit cost or indirect cost or opportunity cost. So, retained earnings is our opportunity cost. Now, then how do we understand when we said there is no method of computation, then what is our understanding of cost of retained earnings? Boss, retained earnings belongs to whom? The equity shareholders. Therefore, cost of equity will be the same as that of cost of retained earnings. It is also indicated as S at times. Therefore, whatever is computed as cost of equity, in general, we will take the same as cost of retained earnings. Now, when I said in general, there is a twist somewhere. One question I have. Okay, you said cost of equity is same as cost of return because they are also equity shareholders, their funds only. All right, all fine, expect return. Now, in computation of KE, in the dividend growth model, what did we say? KE is equal to D1 by P0 into 100 plus G into 100. Here I said if there are any flotation cost minus that flotation cost. Now, if there is no flotation cost at all, then how do I arrive at K, cost of retained earnings? Any of the 6 models, whatever is the model asked in the problem, we can use that model and find out what is our cost of retained earnings, what is cost of equity, and we can say, no, therefore, as per the information, the cost of equity is also equal to cost of retained earnings. But if there is a flotation cost given in the problem, now tell me, what is flotation cost? The cost incurred by the company to float the securities, correct? Yes. Now, where are you floating the securities? In the market. Oh, therefore, for equity, understandable. For debentures, understandable. Now, what is the fate of retained earnings? Are retained earnings floated in the market or are they retained with the company? They are retained with the company. If they are retained with the company, can we consider, logically, conceptually speaking, is it right to consider this flotation cost in computation of retained earnings? No. Therefore, if at all there is a flotation cost element involved, then what will you say? Okay. So, for KE, flotation cost is okay. For KRE, even if there is a flotation cost, please do not consider it. My formula will be simply D1 by P0 into 100 plus G into 100 for KRE. Why? I will not consider this element because I am talking about cost of retained earnings, not cost of equity. Therefore, what happens? There will be a change. Now, this change, okay, you have said you are removing flotation cost, therefore, can we say cost of equity will be less? Boss, mathematical here. You are removing flotation cost from where? From the denominator. Say for example, D1 is 10 rupees and our P0 is some 100 rupees or something. Now, what happens? Denominator is 100, D1 by some 100 minus some 20, D1 by 80, so 10 by 80, 1 by 8. If that is not removed, it will be 10 by 100, 1 by 10. Therefore, which is lesser? Our cost of retained earnings will be lesser. Why? Here in cost of equity, what happened? In the denominator, one number is removed. So, denominator decreases. Denominator decreases, result increases for what? For KE. You are not making any such adjustments. Therefore, the full value is there. Now, the denominator is bigger. Here, the denominator is bigger. The result is, this is anyways constant, smaller. Therefore, the golden rule, KRE is always less than or equal to KE, but never greater than KE. It is either equal to cost of equity or less than that of cost of equity. Now, one more last point, instead of flotation costs, there are something like this, instead of flotation cost, if there are any elements like that of flotation cost which are included for equity but not considerable for retained earnings, should we not exclude them? Yes, even them we have to exclude. What are they? We already mentioned this, brokerage, shareholders tax. Now, will there be any brokerage for retained earnings? No, they are not floated anywhere. Will there be any shareholders tax? They are not paid, boss, as dividends. Why tax for them? Therefore, if the terms brokerage or shareholders tax again come, what will you do? Simply remove that element. Therefore, the other formula of KRE is KE, whatever is the cost of equity, into 1 minus brokerage into 1 minus shareholders tax. That's all. So, this is how we compute the cost of retained earnings. So, friends, now that we are done with the computation of specific costs, let us now move to the final area, the most important area, especially from the examination point of view also, that is computation of the overall cost of capital or the weighted average cost of capital or simply the cost of capital. Now, first of all, before we know how to compute, before we learn, why is it given these names overall cost of capital? Because we are not talking about one specific cost of the capital, we are talking about all of them and hence overall. Now, why weighted average cost of capital? Now, see, do you think every source of capital will have the same weight? Say, do you mean to say if 5 lakhs is equity, 5 lakhs will be debt, 5 lakhs will no, definitely no. The values will differ. Now, when the values are differing, but still you want the average, Will you take simple average? No, no, we will have to take the weighted average, and hence it is called weighted average cost of capital. And the cost of capital is basically, it indicates it is the overall cost of capital, and that is why these names are given. Now, before we jump into the presentational mode, conceptually let us understand how to compute this cost of capital or overall cost of capital or weighted average cost of capital. Let us take a small example. Let us take 4 sources. We will have different values and different costs for all of them. So, let us say the 4 sources what we have are, we will start with term loan, then debentures, then preference share capital and equity share capital. Term loan, let us say some 8%, then debentures will add little slightly higher, say about 10%, then preference share capital say about 12%, and equity share capital say about some 14%. Now, let us say the rupees are in thousands for easy computation. We will take some randomly 200, 300, some 100 and 400. So, total will be some 1000 again in thousands. Now, what is the overall cost of capital? Should we say it is 8 or 10 or 12 or 14, and even the weights are not even, they are also shuffled, the values are different. Now, how do you compute the total cost for this? Very simple. What is the total cost for 200, 8%? Let us assume this is 8% is KT net tax, post tax only. You know how to compute KT, KD considering the tax and other factors. Let us assume for preference share also we have redeemable and we have computed the final, these are all final numbers. Okay, now let us say after we compute all the specific costs, we have these values. Now, what is the total cost? That is 8% on 200 plus 10% on 300 plus 12% on 100 plus some 14% on 400. Is it not the total cost? Yes. Okay. What is 8% on 200? 10% is 20, therefore 16 plus 10% on 300, some 30. Then what is this? 12% on 100, simply 12, and 14% on 400. 14 4s are 56. Yes. These zeros they get cancelled. They are 14 into 4. Yeah. Now 60 plus 13 is 46 plus 12 is 58. 58 plus 56 will be 114. Yes, 114. Let us recheck again. 16 plus 30, 46, 56, 58, 58, 50, 50, 100, 8 plus 6, 14, correct, 114. Now what is this? This is the total cost. Total cost for how much? This is 114, though it is in 1000, we are writing, refers to 1000 only. So, for 1000, the cost is 114. Implies for 100, it is how much? Simply 114 by 1000. Yeah, 100 into 114 by 1000. Now, 2 zeros cancel, 1 0, that is 11.4%. That's all, game over. So, then where do we take the weights? How do we do that? Very simple. See, as such, what do we do here? Whatever 114 is there, divide by 1000 into 100. Now, 1000 is what? Our total fund. Can I expand this 114? This is the conceptual way of understanding, but for examination purpose, for a better presentation, we will use a small format, very simple format. Now, what is that format? Simply just extend this 114. What is the 114? We got it as 8% of 200 plus 10% of 300, same thing we will write. So, this 114 by 1000 we will write it as 8% 200 plus into 10% on 300, 10% on 300 plus 12% on 100, 12% on 100 plus 14% on 400, the whole divided by 1000. So, can we split each term separately? Yes, we can call it 8% into 200 by 1000 plus 10% into 300 by 1000 plus 12% into 100 by 1000 plus 14% into 400 by 1000. Now, these 4 percentages what we wrote here are what? They are our costs. Now these four, 200 by 100, 300 by 100, 100 by 100, sorry, 200 by 1000, 300 by 1000, 100 by 1000 and 400 by 1000, what are they? They are weights. So what are we doing? It is sigma weight into cost. Sigma weighted cost. Now how do you get weight? For that you should know the values. Now what values? For that you should write the source. Therefore, what will be our format of presentation? Source, value, weight, cost, and lastly weighted cost. Source, we know all the four sources. We said term loan, debentures, preference share capital, equity share capital. Then values we gave are in thousands though, 200, 300, 100 and 400. 200, 300, 100, 400. Total came to be 1000. Here we will write rupees in thousands. Be careful with the presentation, friends. Now, what are the weights? 200 by 1000, 0.2. 300 by 1000, 0.3. 100 by 1000, 0.1, 0.4. Now, what are the costs we took? We took costs in percentages. So, I think we took 8, 10, 12, 14, if I am not wrong. Yes. 8, 10, 12 and 14. 8 into 0.2, that is 1.6. 10 into 0.3, that is 3. 12 into 0.1, 1.2. 14 into 0.4, 5.6. Now add all of them. So 1.6 plus 4.6 plus 1.2, 5.8. Yeah, 5.8 plus 5.6 will be 5 plus 5, 10. 0.8 plus 0.6, 1.4. Therefore 10 plus 1.4, 11.4. The same answer. Same answer. This is how we actually present for the examination point of view. The only thing is, you know the values, you will get the weights over. The only thing, you have to compute each cost separately using the formulae, using the concepts what we understood earlier. That's all. Incorporate all this table. If you remember, the game is over. The concept you know. Now, the only thing what you have to be careful about here is, at times what happens in the values, we will have two types of values. One is book value, the other is market value. Now friends, you remember when we said we have to use the book value and market value? Absolutely yes. Now in computation of the cost, depending upon our concepts, that is, if they are irredeemable, go with the market value. If they are redeemable, go with the book value. Correspondingly compute the cost. Now if the first one priority is not available, go with the next one. You have all the book values and market values. Instead of simple one value, you will have to make it two different columns. One column is for book value, one column is for market value. That's it. Now the weights may differ for both. Absolutely yes. And one more special point here. See, in equity share capital, in this problem, in this example, we haven't mentioned retained earnings. One point, please remember friends, retained earnings may have the same cost as that of equity, as we just learnt. Now, equity will have book value as well as market value. What is the market value of retained earnings? There will not be any market value. I'll tell you what, but the market value of equity, whatever is said to be given, that includes the retained earnings component also. Therefore, the market value of equity as such means what? It is the market value of the equity as well as retained earnings. So this is one special point, please keep it in mind. Rest of the things we will only understand as we go into the problems. So this is about the computation of overall cost of capital. One small technique here, when we used to take the physical classes, I used to remember those times there was a song called Kolaveri song, which we used to practice to remember this table, this format very easily. I don't know if you remember the song. It is a very old song. It came some 10-12 years ago. So the application of that song was like this: source, value, weight and cost. Source, value, weight and cost. Write down source and value, put weight and cost, multiply and get weighted cost, add for total cost, source, value, weight and cost. A funny lighter way of doing things. So this is how, and now to get into the problems, once we get into the problems, you will understand lot of better things further.